Today, we're going to cover the 4 invisible tax traps in retirement that catch people by surprise all the time. I'm going to explain what the 4 are, and I'm also going to give you some practical tips on how to avoid them to keep more money in your own retirement accounts. Let me bring in my co-host, Tony. Hey, Tony, welcome to the show. We're going to be talking about the invisible tax traps that catch people by surprise. And I'm going to tell you a quick little story. I had a couple come in recently, and they had everything together. They had enough saved for retirement by any measure. They felt good about it. They knew they had a plan. They just wanted me to tweak it. They came in. I started putting into my software, running my projections, and lo and behold, it didn't match up with what they thought. There was about $190,000 extra taxes going out that they didn't factor in, and they didn't understand why. They were caught by surprise. And I want to talk about, they hit a few of the 4 that I want to cover today.
All right. Well, it would take people by surprise, especially that amount of money. But a lot of people don't really understand how taxes can affect them in retirement. So I'm glad we're talking about this because they are invisible to a lot of people. A lot of people don't factor them in or think, well, it's going to be low. I'll be in a 12% tax bracket or lower and lower than what I'm in now. Don't most people assume that?
Yeah, well, and you'll see some of these are surprising because you don't think about it. You're not factoring in these things. You don't have to deal with them until you retire.
Sure.
So, yeah, we call them invisible. Let me show you what they are. Speaking of invisible, Tony, a lot of people that talk about the show and make comments on it, and you, viewer, you're welcome to make a comment on the show. A lot of people call you, Tony, the invisible co-host because of the insight you offer to this. But that's why we have you. That's why we have you.
Ouch!
So,
ouch!
Beverage.
Oh no!
Holy jeez, look at this one.
Oh no!
So here are the 4, Tony. RMDs, that's starting now, age 73, 75 for a lot of people. Taxation on Social Security benefits catches people by surprise still. As many shows have we done on that, still catch people by surprise. Widow or widower's tax penalty. Then also Roth conversion mistakes. So I'm going to go through each of these real quick.
Yeah, but Dan, it sounds like is this a greatest hits show? I mean, I think you just covered is this the retirement planning greatest hits, Roth conversions, Social Security, RMDs, taxes? It sounds like the greatest hits, but we're really talking about the taxation of these things. So the widower's penalty and the widow's penalty, not so much, but we don't hear a lot about that. But boy, Roth conversions, I can't turn on a financial show without hearing about Roth conversions. And I know you've touched on it, and we do shows on Social Security maximization, but you're putting a twist on that as well because it's Social Security taxation, which doesn't get talked about a lot. So
yeah, no, it doesn't. And the couple that came in that got hit with, when I put the numbers in my program and started talking about why their taxes are so much higher than they expected, they hit on a few of these. And that first one, the RMDs. So a lot of people know they have to take IRA distributions, 401k distributions at 73 or 75, depending on when you were born. But what they don't figure out is exactly what that means. How much is it? And so they have a rough idea that they know they're supposed to take some out, but they don't realize how much it actually is. And when you start adding all the IRAs together and you add growth on top of that between now and when you're required to take them, they start to say, oh man, I didn't realize that. That's going to bump us into the next tax bracket. Boom. And what are you going to do about it? Not take it? Got to take it. Got to take the RMDs.
You have to.
That's going to be the new slogan.
Otherwise, there's well, you have to. You don't have a choice because the government makes you, and they make you pay taxes on those. Because we're talking about, like you said, 401ks, IRAs, traditional tax deferred accounts. So when the money comes out, the money you put in and all the growth, all that compounded interest, it's all fully taxable at whatever tax rate you end up being in with that amount plus whatever else you have. Social Security, pensions, etc.
Right. And so they figure their income, oh, we only need this much, but the RMD puts them higher. Well, we don't need it. Okay. Well,
Doesn't matter.
Doesn't matter. The IRS does. They need it.
Yeah.
Do they need it? For sure. Number 2, Tony, taxation on Social Security. You're right. A lot of people understand they're going to get Social Security. They think it's taxable. They don't know, but no one really understands.
But I
how
heard
much
the politicians
taxable.
recently say that with the big beautiful bill, Social Security is no longer taxed.
It's a pet peeve of mine, Tony.
Yeah.
Oh my. I can't tell you how much I get annoyed by the when people say there's no tax on Social Security anymore. The one big beautiful eliminated Social Security
Let's prepare for another of Dan's rants.
Social Security tax is still there. You still pay tax on Social Security.
Yep.
I don't care if the President Trump says I've eliminated taxes on Social Security for a majority of people. False. All you did was give a tax discount to people over 65. There's no change to the tax code on
an
Social
extra
Security.
deduction, a tax deduction.
Right. Deduction, right.
And it's awesome. And because of it,
I'm not complaining about that.
Because of it, a lot of people won't have to pay taxes on their Social Security.
Right.
But Social Security tax laws haven't changed one bit.
Right.
Up to 85%
right.
can still be taxed, correct?
Right. And for the majority of people with any other income, Social Security is fully taxed, meaning 85% of it's taxed at your ordinary income tax rate. So this couple, they knew that. So when they saw that and I explained it, they were actually surprised that they were paying less tax on their Social Security. And that was because they thought all of it was taxable. They didn't realize that 15% was tax-free.
Sure.
So a lot of people don't factor in the taxation of Social Security and how making more from an IRA withdrawal or interest income for something, rental income, will bump their Social Security into a higher tax situation. So that's number 2. All right. Sorry, I got a little rant there. And I had a little video for it. How great is that? Tax trap number 3, widow or widower's penalty. This is obviously the huge surprise because people don't factor in losing a spouse. If you're single, you don't worry about it. Yeah. You know your single tax brackets. You know your single tax tables, right? But when you're married, you get the joint tax tables. Everything's doubled. Everything's higher. But when you lose a spouse, all of a sudden, you lose their Social Security income, but your tax bracket gets cut. And so your income might not go down by as much as the tax bracket goes down. And all of a sudden now you're at a higher tax bracket as a single than you were when you were married filing jointly. And that surprises people a lot.
Yeah.
But we should probably do a whole show on that. So that being said, this couple, that didn't matter because we didn't show that. I do project life expectancies and I show what happens. A lot of times there's a married couple that it's got a pretty significant age difference. And so when I show both, dying at say 90, well, why am I paying so much more in taxes after my husband died? Well, there it is. You have the same income, but now your taxes go up tremendously because you're at a different tax bracket.
Yeah.
And last but not least, Tony, Roth. You said
Roth conversion. We should have a whole theme for that. It's so popular right now.
It is. And so I want to talk about specifically the subsection of Roth. Doing Roth conversions, not doing Roth conversions, that's for another show. We've done shows on it. But when you do Roth conversions, the purpose of it is to pay the taxes now so you don't have to pay it later. And by converting now, it reduces your RMDs, your required minimum distributions in the future, because there's less money in the IRA that you are forced to take from. Well, that sounds great. Let me do it. What I'm saying is the trap is the most obvious one is when you take money out of an IRA to convert it to a Roth, you're paying tax. You can easily bump yourself up to the next tax bracket that year. And people get that. Oh, if I convert 100,000 of my 401k into a Roth, now I'm going to add that to my other income. So now I'm at 150,000. Yeah, people get that. But what they don't get, well, not everyone gets that, Tony. Some people don't realize that a Roth conversion is added to your income for the year. It bumps you to the next level. But what people miss is how it impacts their health insurance. They forget about Aunt Irma, the income-related monthly adjustment amount on their Medicare premium. They also forget about, if they're not on Medicare, the Affordable Care Act subsidies are now considered, a Roth conversion is considered income, and it raises their income, which reduces their healthcare subsidy.
Sure.
So those are the big tax traps on a Roth conversion that people forget all the time.
Sure. But Roth conversions, if they're done at the right time, at the right point on your time horizon or timeline, can be very advantageous. And a lot of people do make the claim that, hey, we're in historically low tax brackets right now. Taxes, federal taxes are low. And, maybe you don't want to convert if you have $100,000 or $500,000 in a traditional IRA, you don't want to convert it all at once. Probably that would create a huge tax liability and bump you up into the highest bracket, cause all sorts of problems. But maybe it's time, before you hit that RMD age, get some money converted over from that into a Roth. So you have some money in a tax-free bucket, right? I mean,
That's right.
Isn't that a good strategy for some people?
That's it. And that's one of the ones I listed here. So some practical tips are, you want to do a withdrawal strategy that's sequenced. So what I mean by that is, do I take from my traditional IRA first, and then switch to the Roth at the end? Or do I take from my investment account, my savings? You have to coordinate it all. A lot of people just say, oh, I'm going to spend my cash, then I'm going to go to the IRA and save the Roth for the end. That doesn't always make sense. You have to do it based on your tax bracket, your tax situation. So you have to be strategic about it. You have to be strategic about the Roth conversions, like you just said, Tony. You're right. Maybe it makes sense to do conversions in your 60s before you're in your 70s and you're forced to take money out. Maybe not. Maybe you do Roth conversions after you retire because your income is going to go down.
Sure.
Or if you or your spouse get laid off, early retirement, maybe you start doing Roth conversions that year because your income it allows for such. And then finally, QCDs, qualified charitable distributions, might be useful to take some money out of the a traditional IRA, satisfying the RMD amount, donating to charity, getting the write-off, and not paying the taxes on that withdrawal, yet keeping the government happy. So
you can have your RMD directly rolled into a charity or your church. If you're tithing to your church and you write them a check out of your checking account, don't. If you're already taking of RMD age, use that, right?
That's right. Right. We did a whole show on QCDs, so I'll put that up for people to watch. That's a biggie. So I would say that those tax traps, those four are the biggest. There's others, obviously.
Sure.
And those are the four biggies that people forget about. And there are ways to figure them out and solve for them. You just gotta work with somebody that is focused on that. A lot of advisors avoid taxes like the plague. I like to avoid taxes, meaning I like to avoid paying more tax than needed. So that is it, Tony.
Time for the key takeaway.
2 videos in one video. Right? Hey, so here are the key questions you got to ask. Do you know when your RMD is going to start and how much they will be? You got to be able to answer that. Is your Social Security going to be taxable? How much of it will be taxable and at what rate? And third question, how will my tax situation change if my spouse dies? Will my tax situation change? Most likely, yes. And then finally, if I do a Roth conversion, A, does it make sense? And B, will it impact my health insurance costs? Those are the questions you need to ask, thereby hoping to avoid the 4 invisible. They're no longer invisible, Tony. Just because you don't talk about them doesn't mean that they're invisible. You have to address it. So now they're no longer invisible. You know what's not invisible? QR code in the top right. Use that. You can contact me and I can help you avoid these tax traps. Sound like a plan?
Sounds like a plan. Great show, Dan.
Tony, thanks as always for a good show. We'll catch everyone next week.